one of the courses that I teach relatively frequently is personal finance, and we get to a section of the course where we talk about investing and investing for a variety of different reasons, but also for retirement. And we know that that's a very important process. And we do this thing called an investment plan. Students identify what are the different things, their goals and objectives for investing, and ultimately what are the things they could invest in that will help them accomplish those goals and what they can contribute today. And a very common thing that I see is there's a lot of uncertainty with regards to investing. And I think part of that is due to the latest financial crisis and how we obviously saw the negative impact of investing and how you can lose quite a bit of money, truthfully. But the other thing is I think there's always this belief that I'll be in a better position in the future to invest. And I have this mental checkbox that if I just accomplish these things, then I can go ahead and invest. But I'm going to present the argument that really you want to invest as soon as possible. And so I'm going to present what I think are 4 reasons to begin contributing to either your 401k or potentially a 403b or maybe even a Roth or traditional IRA, and why you should start sooner than later. Even if it's not the thousands of dollars that you want to, why you should start sooner than later. So the first reason, or the first argument I'm going to raise is compound interest. Now, compound interest is a beautiful thing in finance. And it is essentially our money, the money that we earned previously, we start to earn money on that money. And what happens with investing is there becomes this kind of cascading effect where the original contributions and money that we've generated from those contributions, we grow on top of that and then on top of that. And it really can snowball very quickly. Just to give you a little bit of an illustration so you understand how this looks, let's just say that we wanted to invest $250 a month for 25 years, and we were going to, let's say we were going to earn a moderate 8% return. Now, 8%, some people might say, well, that's unrealistic. Well, over a 70 to 80 year period, the S&P 500, which of course tracks the performance of just a little bit over 500 large cap equities, earns around 8%. So it's a fairly conservative figure. Now, on a year-to-year basis, there can be obviously declines and rather significant increases. But if you spread that out over a period of time, that's really what you could potentially earn, assuming that you use the buy and hold strategy, which is you're buying the security and you're holding it for a long period of time. If you're buying and selling, commonly referred to as trading, and doing that on a regular basis, you might not get the same benefit, and you really might be doing yourself a disservice, because research has shown that we don't really invest very well and we make decisions based upon emotion. So there's something to be said about buying something and just holding it for a period of time. Now, we're investing for 25 years. Now, this might not be accurate, because if you start investing at 20, you might have 35, potentially 40 years or more in investing. So just know that this number is based on 25, but if you start investing earlier, which I encourage you to do, you're only going to give yourself that much more time. And as you get into the later years, that's when your investments begin to really start to grow. So let's just say, hypothetically, we're going to invest $250 per month for 25 years, earning a conservative 8% interest. Now, over the course of that period of time, we would be investing essentially $75,000, right? So if you were to dump that money into, your savings account or put it under your mattress, which I certainly don't recommend, but it's an option, you would have $75,000, right? Interest on savings accounts is basically nothing, right? So you're going to earn 0.1% unless you use like a high yield one. But if you were to invest it in a good ETF, mutual fund, earning about 8%, you would actually have $237,000 from that $75,000 that you contributed, right? That is the power of compound interest. Now, the hard thing is, it becomes very difficult to catch up when you're investing later in life, right? You can invest the same $75,000 starting at 40, and you're going to end up with a much lower figure than if you were 20, invested that amount, stopped at, let's say, 35, and you just allowed it to mature and continue to grow over those next subsequent 20 to 25 years. So the sooner that you begin, you give yourself a lot more options. And one of the worst possible situations could be if you're, starting a little bit later in life and playing catch up and wishing that you would have done some things differently. The next reason I would argue that you want to start investing is your contributions are tax deductible and reduce your taxable income. So if you've ever gotten one of those unfortunate tax bills at the end of the year, right? You calculate, you take your adjusted gross income, you itemize your deductions if you do, or you take the standard deduction and any kind of other benefits that you receive, and you calculate, this is how much I owe in taxes. And in the event, let's say you owe $6,000 in taxes and you only contributed $5,000 towards taxes, which means you're going to pay $1,000 to the government. Now, anyone who has done that knows that is a not very fun process, right? That feels very bad. So the conventional wisdom is, well, now I have to go back to my employer and I have to adjust either my filing status. So if I'm filing as married, maybe I need to go to married holding at the single rate, or I need to change my allowances, right? So instead of going from 4 allowances, maybe I drop to 2 or to 1. And that's certainly something that might work, right? If you were to look at the numbers, you could zero in on your tax liability, assuming your situation was pretty similar year to year. The other thing you could do is actually contribute more to your 401k or your 403b or your traditional IRA. Now, what that does is that reduces your adjustable gross income. So while you're contributing to your retirement, the other thing that you're doing is you're reducing your adjustable gross income, which means you're going to owe less on your actual taxes. And this is something that I've personally done as I've constantly been kind of tweaking allowances and withholdings and those sorts of things, instead of, or more withheld out of my paycheck, looking at, well, maybe I can do something that actually benefits me long term while also reducing my tax footprint in the process. I mean, that's certainly a very good trade-off. And truthfully, because it's the deductions that you contribute to your 401k or your 403b, if they're taken out of your paycheck every 2 weeks or every month, because they're taken out before you pay taxes, you might contribute $250 towards your retirement, but it might be only costing you, depending upon your tax rate, $175 or $200. And so you're saving a little bit of money, and your money's going a lot further as well. Now, the other thing, and this really only applies to 401ks, is there's often free money available. Many employers that offer 401ks as a benefit to their employees will match contributions. So if your employer, for example, matches up to 3%, you contribute 3%, they'll match that. You're essentially contributing 6% of your gross income into retirement, just giving you further opportunity to grow your retirement and allow it to become a sizable figure so that you have enough to retire comfortably and do some of the things that you want to do, whether that's travel or volunteer or do mission work. I mean, whatever it is that you feel comfortable, again, it gives you options. The fourth reason that you need to be contributing to your retirement, regardless if it's a 401k, 403b, traditional or Roth IRA, is Social Security will simply not be enough. You can go into the Social Security's website, I think it's ssa.gov, and you can use their tool to calculate what your potential benefit would be. And if you can understand any of that, please let me know, because there's probably no website more confusing than the Social Security's website and the tables that they use to figure out how much your contributions are and different things. But they have a really cool calculator that if you log in, you can do some kind of predictions and find out how much you would have at retirement or retirement age. This can be a really good way to figure out if you receive Social Security benefits, what that would be. But what you'll find is it's not going to replace your income. And as a result, unless you want to be struggling financially at retirement or have to work later on in your life, you really want to have a separate retirement account available and really use Social Security as kind of a supplement, right? Knowing that you're going to have that benefit, but using it to do really cool stuff if that's something that you are interested in. So 4 good reasons on why you want to start contributing to your retirement sooner than later. The greatest among those is, of course, giving your money the greatest opportunity and the longest duration of time to grow, thus increasing the amount of money you have at retirement, giving you the opportunity to retire comfortably.
Thanks for checking out this video. If you learned something or enjoyed it, please like and share, and of course subscribe so you can get updates on additional content in the future.